Everyone asks whether private credit is risky, but that's the wrong question. The real question is where the risk actually sits and who gets paid because of it. Private credit isn't a single investment. It includes senior secured lending, rescue financing, and highly leveraged loans, each carrying very different levels of protection. Sophisticated investors don't ask if risk exists. They ask where the risk is attached, who absorbs losses first, and whether they're being compensated appropriately. The structure of a deal matters far more than market sentiment. Documentation, collateral, and seniority often determine outcomes when markets become stressed. Market volatility moves prices. It changes behavior. Banks become cautious, investors hesitate, and lending conditions begin to shift. When fear grows faster than actual business deterioration, disciplined lenders may earn higher yields with stronger protections than they could during calmer markets. As traditional lenders reduce exposure, alternative capital steps into opportunities with greater negotiating power and more favorable deal structures. Two investors can finance the very same company and experience completely different outcomes. It all depends on where they sit in the capital structure. When companies encounter stress, the biggest advantage isn't simply earning a higher yield, it's having the legal rights and structural control to preserve value. Not every investor faces the same outcome. Senior lenders, mezzanine investors, and equity holders each occupy a different seat inside the capital structure. When markets weaken, structure becomes reality. Senior secured lenders may recover through collateral, while equity investors often absorb the largest losses. Unlike public markets, where panic often drives prices instantly lower, private markets respond through negotiation, restructuring, and carefully repriced agreements. Periods of uncertainty often produce wider spreads, stronger covenants, and better economics for investors who can commit capital with discipline. Institutional investors with deep relationships often identify opportunities long before they become headline news. Access can matter just as much as analysis. Today's advantage isn't simply finding yield, it's gaining access to Our focus is simple. Identify situations where market fear has outpaced business fundamentals. Then structure investments with clear downside protection and disciplined risk allocation. Experienced allocators don't chase headlines. They ask where spreads have widened beyond fundamentals, where downside risk is best protected, and which opportunities because traditional lenders stepped away. Private credit isn't defined by whether risk exists. Every investment carries risk. What matters is understanding exactly whether you're being compensated appropriately for accepting it. The best opportunities rarely appear in the loudest headlines. They emerge where disciplined underwriting, thoughtful structuring, and direct market access intersect.